Welcome to the deep dive. Today, we're cracking open the books on a really fascinating company, CoreWeave, Inc., ticker CRWV.
Yeah, they've sort of become the central nervous system for a huge part of the AI economy that's emerging.
Exactly. And this deep dive is all for you, our listener. And we're going to be focusing on their massive Q3 2025 earnings and really the strategic gamble they're making in this hyper-competitive cloud market.
And look, we have to say this right at the top, the essential disclaimer. We are just digging into the source material you provided for educational and informational purposes. This is an analytical chat.
It is absolutely not financial advice.
Not at all. You have to do your own research, your own due diligence before making any kind of investment decision.
Definitely. So our mission here is to unpack this high-stakes story. You've got this company with just massive growth potential, but it's clashing head-on with some pretty high operational hurdles and short-term debt pressures.
Right.
CoreWeave is trading around $77, but it's had this, volatile but remarkable 93% gain over the past year.
Yeah.
So what's driving that? Let's start with the basics. What does CoreWeave actually do?
Well, what's so interesting, if you look at the source material, is that they strategically avoid trying to be, an everything for everyone cloud. They operate a specialized cloud platform. It's really tailor-made to provide scaling, support, and acceleration, specifically for generative AI workloads.
So like a high-performance specialist?
Exactly. Think of them as a premium, high-octane filling station for the hungriest AI models out there, the ones that need serious GPU compute power, specialized CPUs, and that tailored storage.
So they aren't just selling cloud space, they're selling performance. The sources call this their narrow economic moat. It's all driven by that tech leadership.
And they have the benchmarks to back it up, too. They consistently outperform the big general-purpose hyperscalers, your Amazons and Microsofts, in head-to-head industry tests.
Right.
They even achieved SemiAnalysis's Platinum Cluster Max ranking twice. That's real proof their architecture is just highly optimized for this kind of work.
And that innovation edge, it seems to rely so heavily on their partnerships.
Oh, absolutely.
They're often the first ones to market with the really cutting-edge NVIDIA hardware, like the new GB200s and GB300s. And that kind of access it's invaluable when AI compute is the biggest bottleneck in the world.
It translates directly into customer appeal.
Right.
If you're a top AI lab, you need the newest, most efficient silicon, and you need it now.
Right.
And CoreWeave's partnership with NVIDIA lets them deliver on that urgency. And beyond the hardware, they've got their own proprietary software. They call it Mission Control. And their object storage is a huge lure because it offers significant cost reductions.
Okay, and what's the big deal there?
The big deal is zero egress fees. That's a direct attack on the standard pricing model of the massive hyperscalers.
That's huge. Just to put this whole thing into perspective, though, we have to talk about scale. CoreWeave's market cap is what, around $39 billion?
Yeah, about that. But the companies they're really competing against, Microsoft, Amazon, we measure them in the trillions.
Trillions. So CoreWeave is, playing infrastructure chicken with these trillion-dollar giants. The dynamic is just dizzying.
And that aggressive, specialized focus is exactly why they can grow so explosively. Which brings us to the Q3 earnings.
Yeah, reported on November 10th. And the demand story is just phenomenal. Q3 revenue came in at $1.4 billion.
A 134% increase year over year. Those are numbers you just don't see very often.
You really don't.
But the truly historic figure in all this is the backlog. Their total revenue backlog is now over $55 billion.
$55 billion.
And they hit $50 billion in remaining performance obligations RPO faster than any cloud provider in history. That level of committed money from customers, it just says so much about their perceived value.
And they've diversified that customer base, too, pretty quickly. They noted that no single client is more than 35% of that massive backlog, which is way down from 85% at the start of the year.
Right. So the demand is strong. It's diversified. And this brings us to what I think is the core financial paradox here.
Yeah, okay.
Operationally, the company is stunningly efficient. Their adjusted EBITDA for Q3 was $838 million. That's a 61% margin. Very robust. Adjusted operating income was $217 million. Healthy.
Okay, but then we look at the standard GAAP financial picture, and The short-term reality looks, well, brutal.
It does.
Despite those great operational margins, you see a trailing 12-month net income of negative $766 million, and the GAAP net loss in Q3 alone was over $100 million. So their PE ratio is just deep in the negative. You called these strategic losses.
That's right.
But every cash-burning hypergrowth company says that. Where's the proof in the sources that this heavy spending, this deep negative free cash flow, is actually going to pay off before the debt becomes a real problem?
That is the multi-billion-dollar question, isn't it? The proof, really, is in the backlog. They're sacrificing that short-term GAAP income. So the costs of buying and installing all this hardware gets recognized right now.
I see.
To secure these huge long-term contracts that are tied to that $55 billion RPO. The sources see this as a necessary land grab. They have to capture the market share now before the big guys can build out similar specialized offerings.
So they're spending faster than they can recognize the revenue, betting that the demand holds up?
And that they can deploy the assets faster than the debt comes due.
That tightrope walk is the perfect setup for the risks they're facing. Because right after they reported these amazing earnings, the stock took a painful hit, right? Down 25% that week.
It did. And the culprit was the revised guidance.
They lowered their full-year revenue for 2025 to between 5.05 and 5.15 billion.
Yes, and the cause was very specific, and this is a critical point for you to understand. Temporary delays in powered shell data center readiness from a single third-party provider.
Okay, hold on. Powered shell.
Yeah.
What does that actually mean? Let's break that jargon down.
Yeah, fair question. A powered shell is basically the physical building. It's the concrete structure. It's fully equipped with massive amounts of electricity and cooling systems, but it's empty.
So it's a ready-to-go house, but with no furniture inside.
That's a perfect analogy.
That
The
is.
delay wasn't a shortage of GPUs from NVIDIA. It was a shortage of ready-to-move-in real estate for those chips. And that bottleneck pushed their Q4 plans and their CapEx spending into Q1 of 2026.
So the demand is there, the chips are probably on the way, but they literally have nowhere to plug them in yet.
Precisely.
Yeah.
And they're trying to mitigate this now, right? They're diversifying their providers and even starting to build their own data centers. They cited places like Kenilworth and Lancaster, Pennsylvania,
Yeah.
just to get more control over their timeline.
So let's talk about the financial weight of that. The capital expenditure strategy is just astronomical.
It really is.
They guided between $12 and $14 billion for CapEx in 2025, and they expect that number to more than double in 2026. This explains why their free cash flow is a deeply negative $8 billion.
That CapEx is the engine that's building out the capacity for that $55 billion backlog. To fund it, they secured $14 billion in debt and equity this year alone.
Okay.
And they've managed the timeline pretty well, actually. No significant debt maturities until 2028, so that gives them some runway. However, the total debt load is now $18.8 billion. That is a massive amount of leverage.
And that debt load brings us right back to the timing issue. They have to deploy the hardware, start recognizing that $55 billion in revenue, and get to profitability before that 2028 debt wall starts looking really big.
That's the race they're in. But the consensus forecasts, they suggest the payoff timeline is achievable. Revenue is projected to jump from about $5 billion in 2025 to over $12 billion in 2026 and up to $32 billion by 2029.
And that spending is supposed to lead to an inflection point for profitability.
Yes, the long-term bet is very clearly defined in the forecasts. Diluted EPS is expected to stay negative through 2026, around negative 32 cents, but then it's projected to turn significantly positive in 2027, hitting over $2.
So that's the light at the end of the CapEx tunnel they're building.
That's the plan. And that forecast leads us straight into analyst sentiment, which has been understandably volatile.
Yeah, after that guidance cut, we saw immediate revisions. Melius Research, for example, lowered their price target to 140 from 165. Jefferies cut theirs to 155 from 180. The market is adjusting to these deployment risks.
Yeah, but despite those cuts, the average analyst price target over the last 6 months is still pretty robust at $145. But we do have to acknowledge the huge divergence in how people value this company.
What do you mean?
Well, the sources list an internal fair value that's actually close to the current price, around $80. But their long-term price target is listed at almost $400.
Wow.
That massive gap just shows you the conflict between what the company is worth today on paper versus its massive future potential.
Okay, so let's boil this all down for the listener. What is the core bull case for CoreWeave?
The bull case is that they are the undisputed tech leader in specialized AI cloud. That's confirmed by benchmarks and their NVIDIA partnership. They have an exceptional diversifying revenue backlog of $55 billion, and their strategic CapEx is backed by enough financing to get the job done.
And the bear case, then, has to focus on that financial tension.
The bear case is that CoreWeave is racing the clock. If that $18+ billion in debt comes due before they can fully monetize that backlog, especially if these operational delays continue, they could face a serious capital squeeze. And, of course, there's always the risk that the trillion-dollar hyperscalers finally decide to get serious and build out their own specialized GPU infrastructure.
So when you collect it all, the entire story for CoreWeave right now is just this incredible high-stakes trade-off.
It absolutely is. The core tension is balancing that rapid necessary capital spending, that 12 to 14 billion this year, doubling next year against those critical short-term operational risks and the GAAP losses. They just have to execute flawlessly to bridge the gap from where they are now to where they could be.
What an illuminating deep dive, a company right on the bleeding edge of the entire AI infrastructure race. Thank you so much for sharing all of these sources with us and helping us analyze this really complex story.
It was a pleasure to go through it all.
And thank you, our listener, for tuning in and for trusting us with your source material. If you found this deep dive valuable and you want more focused breakdowns like this, please subscribe to the deep dive and make sure you hit that notification bell. Your support helps us keep making these. And remember, the best research is always your own. Until next time.